My name is Ognan and I welcome you to the Dividend Method channel. In this video, we get into probably the most heated and important topic in the investment community. A topic that underpins all your investment decisions and ultimately your whole investment strategy. Literally, if you're not familiar with the details of the growth versus dividend investing debate, you cannot even begin to invest without doing it blindly. Let's begin with defining the two terms. Growth investing, broadly speaking, is a strategy focused on capital appreciation, which is a fancy term for price increase. Basically, what growth investors do is invest in a stock and wait for the price to increase. The only way they make a profit is when the asset is sold at a higher price. On the contrary, dividend investors, or more broadly speaking, income or cash flow investors, put their money to work in an asset that pays them for owning it on a regular basis. That asset can also be sold for a profit at a later date if the price has increased, but that is typically not the focus of the investment. Now, let's get to the advantages and disadvantages of each one. Let's start with the advantages of growth investing. Generally, it is accepted that growth investing brings higher returns alongside higher risks because it is focused on not yet proven but rapidly growing businesses that are most of the time in newer industries. Think AI, biotech, crypto, cybersecurity, robotics, etc. These companies are expected to grow their earnings faster due to the exposure to secular trends and their expansion from a smaller starting point. The line gets a bit blurred here because companies like Microsoft or Johnson & Johnson are both exposed to sectors with huge innovations happening all the time, the technology and healthcare sectors, yet they are also more established, large and stable companies with a lot of history and are both dividend payers. Regardless of those outliers, generally these companies don't pay any cash flow to their shareholders and reinvest everything back into the business. This has one major advantage and one major disadvantage. The advantage is that the company expands their business faster if they reinvest everything back in it, potentially allowing it to capture more market share and dominate its rivals. However, the disadvantage is that if the company makes a wrong move, it might have kept your money for a decade, not pay you a dime, and then go to zero. So not only do you lose your invested capital, but you never even got a single penny from the business. So this is always something to keep in mind. Another advantage of these types of investments is that they're most of the time more tax efficient. You will see in a bit why I say most of the time. The general rule is that when they reinvest back into the business and they're doing well, their share price will grow, and that represents a so-called unrealized capital gain, which doesn't trigger any taxes for the investor. It is unrealized because you have not sold the stock for a profit. However, as I said earlier, there are situations in which this isn't true. One such situation is if you have to rebalance or take profits often. In that case, you constantly have to sell shares that have gone up in price, triggering the so-called capital gains tax. Another reason why these investments are not always more tax efficient is that for some countries, there is the option to hold stocks in a retirement account in which if the company distributes dividend, it is not taxed. So that removes the tax advantage of the non-dividend payer. Now, let's see what the disadvantages of growth investing are. The first one is that generally these types of businesses are smaller, riskier ones with less history. This makes them a lot more volatile in bear markets and also poses a lot higher risk for your capital. As I said, there are outliers because Amazon is often categorized as a growth stock and it definitely is not a small company. But even if we account for the big corporations in the growth sector, like Amazon, Tesla, Meta, etc., they are extremely prone to violent downturns when the liquidity in the economy starts to go down and central banks raise their rates or implement quantitative tightening, which is a fancy term I use to make myself look smart. But it basically means pulling money out of the economy. We saw that in 2022. When you couple that with the fact that they're not paying any cash to their shareholders while their price is going down, it adds to the risk. This leads to the second disadvantage. When you invest in these companies, you don't get anything until you sell, which means you have to wait years and years and wait the price to go up to finally realize a profit. And that can certainly be a nerve-wracking experience. That means that the only way for you to profit is the so-called greater fool theory. When a company is not distributing cash, the only reason to hold it is to sell it for a higher price. But every single person that buys it thinks he's getting a bargain. Well, that's a logical failure. If everyone is getting the bargain and at the same time everyone is relying on selling the asset to someone else, someone in this chain of transactions will be left holding the bag. Each person buying it hopes they are smarter than the person they're selling it to and that the buyer will be the greater fool. The problem is, sometimes this greater fool turns out to be you, and it's hard to predict it. Why is it hard to predict? Well, because of the third disadvantage. It is really hard for an investor to assess whether the company is fairly valued or not. Because there is no dividend, you can't anchor your analysis or expectations into anything tangible that you get as a benefit. You are only hoping to sell it for a higher price. But the market is a forward-looking mechanism that is always looking ahead in the future. Just because you think a certain industry, let's say AI, has a lot of growth and development doesn't mean that the current companies in the industry are not ridiculously overpriced. A good example is the dot-com bubble. The dot-com bubble was the unsustainable increase in prices of internet companies in years 99 and 2000, which led to a huge bubble that eventually popped. Was the internet the next big thing? It definitely was. Were investors right to be excited about it? They definitely were. However, that did not stop them from losing a lot of money and investing in companies that went bankrupt. And if you invested in the Nasdaq index, which I will use as a representative of the growth companies at the time, you did not go back in the green until 2015. Think about it. 15 years just to break even from assets, most of which did not even pay you any cash while you were holding them. Here is a chart of the Nasdaq during the dot-com crash. The arrow points to its highest point in 2000. And then here is the point in which the price again reached the same level from the previous image. It is 15 years later in 2015. Remember, certain companies or sectors might have a bright future, but that doesn't mean that they aren't grossly overvalued today. Another disadvantage of growth stocks and investments in general is the fact that since you don't have any cash flow, if you need to fund any type of expense, you need to sell shares. Let's take as an example the famous 4% rule. It says that each year you're allowed to sell 4% of your shares safely because the growth of the market will make up for that. However, ask any retiree that got into retirement with that 4% rule during a prolonged bear market, and you will find out why this likely isn't a good idea. Here is the math behind it. Let's say you have $1 million in your portfolio. You are allowed to sell 4% of it, meaning $40,000. You have decided that this is enough for you to live, and so you decide to retire. However, market drops by 30%. Now you have $700,000. If you want the same 40,000, you have to sell 5.71% of your portfolio instead of the 4%. Oops. And if by some chance we enter into a so-called lost X number of years period and you don't have cash flow, things get really ugly. This phrase is used for a set of time in which the stock market isn't going anywhere. You will sometimes hear it as a lost decade in the media, but it can be for any number of years. Here is a visualization of what that means. It's a chart of the S&P 500 index that supposedly always goes up and is inflation adjusted. Now, granted, it does go up over time, but check this out. 30 years, then 24 years, then 15 years of lost periods. Will your retirement start being such a period? No one knows. It's a gamble. It's a gamble with your life. Can you afford that? Imagine what this famous 4% rule will do to your portfolio in such periods. You will get wrecked. The last disadvantage of growth investing I will talk about is the rebalancing issue. Naturally, you will get some companies or ETFs that will do better than other companies. It is an absolute nightmare to always think of which one to trim and which one to add to. Is it overvalued now? Or will it continue to grow and investors are right to be piling in it? What do I do? If I sell, when do I get back in? Oh no, I will pay a lot of tax on that one. It is a nightmare. Dividend investing eliminates that, at least for me, because my strategy is that I am interested into how much capital I put into a company and how much cash it gives me. And then I just stick to certain limits of maximum exposure, and that's it. All right, speaking of dividend investing, let's get into its advantages and disadvantages. Starting with the disadvantages. The first one that is always brought up is taxes. Generally speaking, dividend investing is more tax inefficient because when you receive the dividend, regardless of what you decide to do with it, you have to pay a tax on it. But not always. The next disadvantage is the argument that the companies are only paying dividends because there is no more places to invest the cash in. That is true. Usually, a growing company will need every dollar they can get so that they can expand and take more market share. Each dollar that they pay out to shareholders is a dollar that could have been used to open a new store in a new location, or create a new factory, or develop a new technology. I personally don't mind that since it shows me that the company is mature and stable, but this is something that comes down to your personal preference and the risk tolerance that you have. I like companies which are dominant in their niche or local markets and can afford to still grow, but also take part of the profit to reward me for investing in them. The last disadvantage I will talk about when it comes to dividend investing is that the dividends are not free money. I think that argument is a bit superficial, but I see it all over the internet, so it would be dishonest if I didn't include it in the video. The argument says that at the time of paying the dividend, the share price drops with the amount of the dividend. Now, while that might be technically true, it presumes that people think that something like free money exists. So, as I said, it is a bit superficial. And besides, as we discussed, the market is a forward-looking mechanism. That means that when investors identify a company as a reliable source of cash flow, they will naturally want to own it, which in turn drives the share price up. Yes, when the company moves its cash from its cash balance and deposits it into your bank account, it theoretically loses value. But hey, you get to pay your bills. So again, it's a weird argument and I won't spend more time on it. Now let's move on to the advantages. The first one is that as a rule, dividend-paying companies are more mature and stable. Generally, they have been around for longer, and besides that, the fact that they are paying out cash flow to the shareholders is a stabilizing factor. Why? Well, because of two reasons. First, dividends can be manipulated. It's cash in your bank account. There are no accounting tricks, GAAP accounting versus non-GAAP accounting. This stands for generally accepted accounting principles, etc., etc. Second, the commitment of the management to pay a certain amount of dollars to the shareholders is a disciplinary factor that holds them accountable and is more likely to stop them from making foolish decisions. The second advantage is that dividends are a lot more stable than share prices. If we take a look at any of the famous dividend pairs, you will see that. Growth investors worry about the price fluctuations non-stop, but the dividend investor can hold on to a quality business and just watch its cash flow grow, ignoring the ups and downs of the market. I have prepared a few examples for you. This is the 10-year price chart of Procter & Gamble. You can see the ups and downs. This is their 10-year dividend chart. Notice the stability? It is only up, no exceptions and no downturns. The 10-year price chart of Johnson & Johnson. Again, you can see the fluctuations. And here is their 10-year dividend chart. Same as with Procter & Gamble. All right, I think you get the idea, but here is one more, even more dramatic example. Here is Realty Income's price chart. A bit of a roller coaster here. Well, how can you isolate yourself from that roller coaster? By focusing on this chart instead. Here are Realty Income's dividends for the past 10 years. Which of these charts allow you to sleep better? As the saying goes, the picture is worth 1,000 words.